When you're looking to buy a property these days, you can't get good returns unless you're looking at doing some kind of a value add deal or repositioning the property, right? You can't just go buy something with great returns. You have to kind of build it, either doing some renovations or, the more substantial those renovations, the more value you're adding, right? And that's where a big chunk of your profit is in the deal. And that's why in new construction, it's 100% value add. It's all new construction. So that value add, what it means is, as soon as that property is complete, your appraisal is going to jump up much higher than your cost to do it.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 347. Have we reached the point where it no longer makes sense to invest in older multifamily properties? My guest today makes the argument that there is nothing passive about investing in older properties because they constantly need repairs and updates. Instead, you should be considering new construction multifamily and building as much as you can, as fast as you can. Roger Luri has been a real estate investor and developer for over 30 years, and he's the author of the recent book, Don't Buy Multifamily, Build It. Roger, welcome to the show.
Hey, Brian. Nice to meet you. Thanks for having me.
Tell us a little bit about your background in real estate and development.
Well, I started back in the 1990s, started building a lot of high-end multifamily and even single-family homes here in Chicago in the city market. And I had the unique experience of being on the board of a community bank, and we were real estate lenders during the heydays of the 2000s and then going into 2008. So I really had a chance to see which projects fared the best through that period of time, which was great, right? And, coming into right now, the properties that really are the best investments, I feel, are in the higher end properties in the markets. Those are the Class A properties are most impervious to fluctuations in the economy because those buyers always have the money, regardless of what the economy is like.
Explain that. So the Class A, which would be the newer builds, either, what would Class A be, 10 years or younger?
Class A are your newer buildings in really desirable areas, in the best areas, right? And these are the properties that attract more affluent buyers or renters or buyers if they're condos, right? So in those areas, it's not really the property that makes the difference as much, although that's what people always think of, but it's the actual tenants or purchasers of those properties that matters, because those people, again, they're more affluent, so they're not as affected by little fluctuations in the economy. They're not as worried about inflation. Gas prices go up a little bit, it doesn't hurt them so much, right?
What is your argument then against the older multifamilies, the B and C class that are a little bit older?
That's a big part of what my book is about. And, there's actually a lot of numbers in the book, a lot of information in here. And if people get the print copy, they can download from my website. We'll give it to them later. They can download the ebook, which it makes it easier to look at all those charts and things like that in there. But in any case, when you're looking to buy a property these days, you can't get good returns unless you're looking at doing some kind of a value add deal or repositioning the property, right? You can't just go buy something with great returns. You have to kind of build it, either doing some renovations or, the more substantial those renovations, the more value you're adding, right? And that's where a big chunk of your profit is in the deal. And that's why in new construction, it's 100% value add. It's all new construction. So that value add, what it means is, as soon as that property is complete, your appraisal is going to jump up much higher than your cost to do it. Much like with a rehab project, you see the same thing. The appraised value, once it's stabilized, jumps up. And that jump in your appraised value, that equity bump, I call it, is where you get a big chunk of your profits in the deal. That's what helps you build wealth faster than if you just bought a stabilized property and sat on it, right? Then your returns are much lower.
Basically, the value that you're adding as you build the building compared to what you're spending to build it, there's that delta there, and that's the value add. And then at the end of the day, you have a brand new building, so your expenses should be lower. Is that kind of the thought?
Well, right. And that's, I go into that in the book. That first 5 years or so, that's your honeymoon period with the property. It's all brand new. So your cost to run it is going to be very, very low. And this is why that equity bump that we just talked about and that honeymoon period there, that's why, big syndicators normally what they're looking to do is they're looking to go in, add the value, or build new if that's the case, which is what I'd say certainly the numbers are better. But when you build it, you hold on to it for those first few years, and that's when you're going to get the most return, the biggest IRR during those first few years. Because you've got that equity bump initially when it's stabilized, your first few years operating, your expenses are low, and then you sell it. And most syndicators are looking to sell after 3 to 5 years, right? And that's your sweet spot, because after that, your costs to maintain that are going to start going up. You have to start replacing appliances and things like that. And your costs are going to go up and your IRR actually goes down.
Let's kind of start with the Class B and C older properties and the problems that they have that you're eliminating by having new build. I want to dig into just this argument that you shouldn't buy existing because the value add bump you're going to get is better with the new build. Talk about it from the older property perspective.
Don't get me wrong. I'm not saying you shouldn't. I'm just saying that the numbers are better. But, it takes a different set of skills to build a new property. So there's a learning curve there. Now, if you're getting involved, as I work with investors, equity investors, and passive investors. So if you've got a developer you're working with passively that's doing new construction or doing renovations, you'll see that looking at the numbers in the deals, the numbers are, better. Your returns can be better with new construction deals. In general, you can't generalize about everything, right? But that's not to say that it's not a good idea to go into other deals, but it's just, you have to go with things. And most of your viewers, I assume, are doing this for themselves. Some may be passive investors, in which case you kind of have a choice who you invest with. But if you're doing it for yourself, you go with your own skill set, and in order to do something new, you have to get a new skill set to do that. That's what my book is about, kind of bridging that gap and learning some new skills.
So full disclosure here, I'm both an existing apartment investor and developing new build multifamily. There's a couple factors here that always give us pause when we're looking, because I have a development team and we're always looking at different opportunities. And the thing that I've seen here in the Grand Rapids area is that it's very expensive to build, especially now when you have supply chain issues, increased labor costs, increased material and costs. Luckily we've had high rent increases to offset that. But what I've seen is that most development projects that we look at don't get off the launch pad because those expenses are so high. And when we look at the value of the property, once it's stabilized after, say, a 24-month or 36-month period, it just barely gets up to that value we put into it. So you have to go and get other things to fill your capital stack, like grants and incentives from the city or the state or the federal government. What is your experience with that? Are you finding projects that pencil out, or what is your secret sauce to make them pencil out?
I don't think there's a secret sauce, but it's a lot of what you're talking about is dependent on the area that you're in. And I kind of touched on that earlier, which is why I'm focused on, like in Chicago, the Lincoln Park area, which is some of the most desirable area of the city. Here, and I know Grand Rapids is a little bit smaller town than Chicago, but here in Chicago, big developers are putting up high rises and new office buildings in this Fulton Market area and West Loop area like there's no tomorrow. And they're getting huge rents for these apartment towers. They're doing some condos over there, but a lot of new offices and a lot of it's like they're building a whole new central business district, but it has residential mixed in with it, and entertainment and everything else there. So it's very popular right now. And these areas will support the numbers. Even as the construction numbers go up, the rents are going up enough to support it. And because interest rates are low, it makes the whole equation work. Other areas may not support it as well. And if you're looking at an area where your values are such that you're getting some grants and things like that, your values in that area probably are not as high in order to support that new construction endeavor that you're looking at. So, again, it's a balancing act. And as you're looking at these numbers, you got to pick and choose, So if you're in an area that it's not going to work, you either have to move to a different area or do a different type of deal, right?
So maybe I'll come to Chicago and we'll build developments together.
Come to Chicago, yeah. But so many cities, and in the Sun Belt and that, there's a lot of this going on. So it's very dependent on where you are.
What do you find that helps make your deals pencil out? Because here in Grand Rapids, with zoning and just construction methods, you're basically going to have 4 stories if you can get up to 4 stories on a larger multifamily. I know in Chicago, you're talking about high rises, so you can go up as many stories as you want. And that helps offset the cost of the land and everything. What do you look at to balance out to make sure that, okay, what are the top 5 factors, I guess I'll ask, that make it a project balance out, when it comes to acquisition cost of the land, construction costs, those types of things?
Your land has to be worth the money you're paying for it. And the land, really, the value of the land is based on what you can build on, right? And if you can only build so much on it, you can only go so tall, only got so much density with your zoning, then that kind of sets a top value for the land. For example, some of those areas I was just talking about, like the West Loop, I built a townhouse project over there in the early 2000s in the West Loop. And at that time, there were projects coming up, but the city at that time wouldn't let you go over 4 stories in that area. But now they're building 30-story buildings over there like crazy. And so, of course, land values went up a lot along with that because you can build so much more on it. So now one of these sites is worth a ton of money over there, but at the time, so things can change. So maybe zoning in a certain area of the city allows you to go taller, then of course land is going to be worth more. But of course, the people that own that land always want more than it's worth. So you're always trying to purchase it just like any property at a price where your whole deal is going to make sense. A lot of times for developers, you're looking at getting a piece of land and then rezoning it so that you can get a little more out of it, and that can help your numbers make sense. So maybe that's something in your area, if you can find a site that you're going to be able to rezone and push the value up. You have to be careful with those kind of deals because if the zoning doesn't go through, now your site is worth less than you paid for it.
What other tricks do you have to help make new development pencil out?
I think one of the biggest things with new development is you want to be able to build a really quality product. And it does take some experience to know that you're going to be able to build the quality that you need at the price that's going to make sense, right? I always suggest start out with a smaller deal and kind of work your way up, if you're just getting into new construction. And a great way for people to do that is with an owner-occupied building because they're easier to finance. So if you can do a smaller building, owner-occupied, you can build yourself a beautiful new place and have a couple other apartments in there that help pay down your mortgage.
So when you say owner-occupied, you mean like a house hack where you're going to live in one of the units and then build out the rest?
Yeah. And in Chicago, those would be like a 2 to 4 unit building usually you'd be looking to build here. Right? So it depends on your area where you're at.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is health care for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
For our listeners who have never developed or thought about new construction, can you just kind of break down the financial model, like how you look at it from cost per square foot, what your costs are to build it out versus what your income would be? And I know it's typically on a per square foot basis, but can you kind of take us through that financial model that you look at?
I do say one of the big things I say in the book is that if you're looking to get started, find somebody else who's doing something similar near you that you can use and look at as a model. And a lot of times, if you haven't built anything before, you're going to want to get a contractor to build it for you, a general contractor. Hey, if somebody's building a building and you think, oh, I could have a building like this, go to the contractor and say, hey, what would it cost me to build a building just like this on my site over here, right? That's a great place to start if you can do it. Reinventing the wheel is more difficult if you're trying to find a product that's going to fit into a certain area and a certain market. It takes a little more experience. Better to start with something where somebody else has already kind of proven the product there and do something nearby that's not too different from what somebody else is doing. And then you can kind of put your own touch on it, how you can, I can make this a little better by doing this or doing that, right? That's always a good way to go, you know. There are so many different ways that the numbers can pencil out on different deals that it really varies. But first thing you're going to do is you're going to find an area that you think you can do a certain type of property in. And probably you've seen somebody else do something similar, right? And then find out what zoning you need in order to do that on a given site. And you're looking for a site. And a lot of times in an urban area, those are going to be tear downs. So you got to kind of be looking for where you can find an appropriate site to tear down and get it going, you know. And again, you have to be careful of the zoning and all that to make sure you've already got it, that you know you're going to be able to build what you want to build. And it takes a little practice, you know, penciling out some numbers, talking to some architects. That's why I say the easiest way is if you've got a contractor that's already building something, get a number from him, and that's going to be a pretty close starting point for you, right? And kind of work from there.
What's your niche? I mean, do you build property, multifamily of all sizes and all types, or is there a particular niche that you gravitate toward?
You know, I was building, and I had a couple architects working for me, and I was building properties in the 2000s. And in the later 2000s, I was actually working on a couple of deals to build my first high-rises here. And I had one all put together and partners and site and everything, but I won't go through the whole story, the whole war story, but it didn't go through. And then the market softened, and then there was no more high rises for quite some time. At that time, I actually opened a martial arts school. I've been doing martial arts for 40 years now. And I had always had in my mind I was going to open a school, and there wasn't much to do real estate development-wise. So I opened a martial arts school here in Chicago, which I operated from 2011 till about 2020, beginning of 21. And closed then because of COVID. But I've always wanted to get back in the market because everybody's building all these things all around me here now, you know. And so I'm getting back in, and I'm starting out with smaller projects. And the projects that I'm starting out with are in, again, these Class A areas, which in Chicago is the Lincoln Park area, and putting up smaller 3 and 6 unit buildings. You know, land prices are very high here, and unit prices for sale are also very high. And these things are selling out as condos before they're even complete. And I've done a lot of for sale units, condos, so that's an easy market for me and great returns for my investors. So that's what I'm getting involved with right now and kind of looking to grow again and get back up into it there.
What's your trajectory? Where's it going to take you? Are you going to go back to the high-rise concept, or do you like the condos?
We'll see. I mean, I want to build a strong investor base and get a lot of these smaller projects going. And then from there, it's kind of a natural thing when you get into this that you kind of, the size of your projects kind of grow. And having been down that road before, I mean, I already understand all the mechanics of all that. So it's pretty easy for me to segue into that once I have, investors and kind of get going with all that.
And what are some other tips from your book? Because you wrote the book, Don't Buy Multifamily, Build It. What are some of the other tips and tricks and techniques that you have in the book?
There's a lot of stuff in there. It's a small book. It's a pretty quick read. In fact, I had a developer builder here in Chicago. When the book first came out, he went on the website and I gave him a call. It was a Saturday morning. And he said he had just finished reading my book. He got it early in the morning, and he just was reading the whole thing. And we were laughing. I talked to him, because he lives not too far from me here, and he's been looking at getting involved in doing this. He builds homes out in the suburbs, right now. But in any case, it goes through a lot of things. It talks about zoning. It talks about, for example, if you're just getting started in this, a good way to do it is with, as I said, an owner-occupied property. But in order to do an owner-occupied new construction property, you have to be pretty well capitalized. It's not like you're just starting out with one of these burr projects or something like that. You need a pretty good chunk of capital to put up a new building, right? Now, if you're already doing rehabs and building big multifamily properties, you would think that you'd be able to segue very easily. But again, it's a different skill set and a different mindset that it takes to build new construction. You've probably experienced this yourself. It's a different mindset from when you're looking at, buying and fixing up and doing a value add or, repositioning a property like that. So it takes a little different skill set, and you have to develop that kind of a little bit at a time. And so even if you've done a bunch of big rehab projects, doing the construction is different because you have to really be focused on quality, and it's a whole different level than what you would do in a rehab project.
Give our listeners your best argument for why they should consider going down this road and building and developing their own multifamily.
There are a few reasons why, but number one, I think just from an ownership standpoint, it's a lot better to own a new property. It just is so much easier. And the tenants, the level of tenants you're going to get, you're getting much more rent. Those people are just going to be easier to deal with as tenants, and it's just going to be easier across the board. Your properties are going to be worth more money, and again, if you're marketing them and selling them, your returns are going to be higher, but you have to kind of be looking at how long you're holding it and when you're going to get out. I think this is one of the mistakes that people make a lot. There's this idea that you buy a property and you just hold on to it forever. And of course, that's one strategy. But you don't see too many of the big syndicators doing that, right? And there's a reason. It's because the returns are higher when you're able to come in and out of a property every few years. And you just get higher returns. So I think as an investor, it's starting to look at those returns and say, well, how do I maximize my returns rather than, just accumulating things, right? And I think for a lot of people who get started, it's just a matter of accumulating properties. And they figure out the more properties I accumulate, then the richer I'm going to get. And, there's certainly some truth to that. But you can maximize that equation if you do it from a little bit more professional standpoint, right?
Tell our listeners how they can get a hold of you or find out more about you, and make sure you mention your book again.
It's Don't Buy Multifamily, Build It. It's on Amazon. I actually have another book there also called Don't Buy a New House, Build It. And it talks about why you should build your own new house too. And for the similar reasons I was talking about with that equity bump. But you can get a hold of me at my website, which is ld2development.com. And if you grab a copy of the book on Amazon, again, you can go on my website and you can get a free download of the book there. There's a PDF download you can get from my website. And so if you get the book there, again, some of the The charts in the book are easier to read. If you get the ebook, you can put it on your screen and blow it up and look at all the numbers in bigger format. So that's a good way to go. So ld2development.com. You can also go to our YouTube page, LD2 Development. Or you can find me, Roger Luri, on LinkedIn.
Well, Roger, thanks so much for coming on the show today to talk about new development of multifamily housing. Really interesting that you're doing it in Chicago, and you shared some good examples and stories with us. Thank you so much for having this conversation with us today.
Brian, thanks for having me. It was very nice to meet you. And you're not too far away if you're in Grand Rapids, and hopefully we can get together and actually meet in person one of these days.
Yeah, you'll have to take me on a tour of some of your properties in Chicago.
I'd be happy to. If you come out to Chicago, I'll be happy to take you around and show you around a little bit.
Awesome. Well, thank you so much.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.